Hello and welcome back to Kitco Mining's Digging Deep with me, Paul Harris, in which we take a closer look at some of the most interesting news items in the mining and exploration space. Joining me today is Joe Mazumdar, editor at Exploration Insights. Joe, welcome back to Kitco.
Thanks, Paul.
We are in a new record zone for gold as it approached $3,600 per ounce, and silver has broken $41 per ounce, its highest level in about 14 years. Mining is where it is at, and this is our day in the sun, so let's enjoy it. The World Gold Council unveiled its vision to transform the global gold market through the introduction of fractionated digital gold. Joe, digital gold has been a topic on people's lips for quite a while now. Why is it necessary for the yellow metal to go digital? Is this to face investor competition from cryptocurrencies, stable coins, and the like?
Yeah, I mean, I would say that the way retail investors get exposed to physical gold is more through coin and bullion, rather than, like, say, fractions of a gold bar. Making this a little bit more fragmented, cheaper, in terms of anybody could get exposure at a fraction of the overall bar, whether it's a 100-ounce bar or a 600-ounce bar. Probably makes sense to get a bigger audience into actual physical gold. And it probably has some idea with making it similar to crypto. For the next generation who understand that better, maybe.
Okay, now fractionated gold, as you say, is perhaps aimed at the small investors. Small investors, of course, can buy single ounces on Kitco, but why not buy a chain or a coin, as retail investors have done for years, if the idea is for investors to have fractionated gold, smaller denominations of gold?
Yeah, as we know, a lot of the demand for physical gold is in jewelry. I mean, that's been declining because it's very sensitive to gold price. So it might have been 45-50% on average. It's gone down to below 40 because the gold price is up so high. I would say, like, in jewelry, that's a less liquid market. You pawn it off, or you have to find some buyer. You might think it's worth this, somebody else thinks it's worth that. The design might be worth more than the actual gold, or the other way around, if people don't like the design. So this is a way of just having pure gold exposure with no other factor impacting the price or its liquidity. So even though you own a fraction of it, you still gain the liquidity of the entire market without trying to say, my 16th is worth more than your 132nd or anything like that. Everything's worth the same, and you get the same exposure if gold goes up 30% or not.
Okay, now for those who are sensitive to the gold price, it's perhaps been a tough week. The gold price moved around sort of $200 per ounce upwards this week to a near record $3,600 per ounce. Joe, why did the gold price make such a big jump this week?
Well, I would say, what's happening in the gold price right now, and I think that's converting into gold equity ETFs, especially from North America, is that the U.S. administration is making a big move in terms of trying to control the U.S. Federal Reserve, which is supposed to be independent, to try and push for a rate cut and consecutive rate cuts potentially, and that would have the impact of lowering the service costs of the cost of servicing the debt. The debt's ballooning, obviously. I think right now it's about 100% of the GDP, but some people have it at 120, depending how you do the math, and growing. And if the tax cuts come in, that might actually get bigger. And if it does get bigger, right now I think the cost of the debt is servicing the debt is about $1 trillion a year. That just goes up and becomes a bigger part of the entire U.S. budget. So one way of controlling it, if you can't control your predilection for spending more than you make, is to lower the cost by keeping the interest rates low. Any indication that the real interest rates are going down is a positive for gold, and that obviously had its knock-on impacts.
Now, gold isn't the only precious metal getting headlines this week, as silver crossed the $40 per ounce mark as well. Joe, how significant is it that silver crossed to the upside of $40?
Well, I think it's very significant in that a lot of people have been waiting for the ratio to contract because it's been quite elevated. But right now, I think silver is along for the ride, and silver, as we know, is a bit of a different beast in that it's got its industrial demand, which is more important than the industrial demand for gold, which is the tech part of gold demand is like 7 or 8%. It's a bigger part of the silver demand, and with green energy, there is potentially more demand for silver. But right now, I think the ride that silver is taking is basically on the coattails of gold.
Okay. Now, with high precious metals prices, the miners are making money hand over fist, and looking to make even more money is Newmont, the sector leader, which is planning job cuts in a cost-cutting drive with the target of reducing its cost by about $300 per ounce, according to news reports. Newmont had an above-average all-in sustaining cost of $1,593 per ounce in the June quarter, hardly the performance one expects from a sector leader. In late 2024, it initiated plans to dismiss some senior managers and recently cut 19 positions at its headquarters in Denver, according to local news reports. Joe, it's good to see Newmont looking to improve its margins. Exploration is usually one of the first things that gets cut when a company looks to reduce its costs. Is that going to be one of the targets here for Newmont?
Well, I mean, in terms of percentage, they're right around the average in terms of, like I did this H1 review of gold producers, about 28 of them. And Newmont, in terms of costs overall, because they have the economies of scale in terms of revenue on a percent basis, are not out of line in terms of what they're spending on G&A, and they're not over the average in terms of exploration. But on a percentage basis, on a bigger revenue number, they spent about $200 million on G&A in the first half of this year. And their big objective, because it's hard for them when you get to that kind of production level to show any growth. And so your objective is to outperform your biggest competitor, which would be the gold equity ETF. Your big thing about the gold equity ETF is you offer dividends and you can potentially do share buybacks and return more to shareholders. And my calculations on how much they return to shareholders in terms of on a percentage of free cash flow generated, which gets allocated to dividends and which gets allocated to share buybacks, was well over 60%, higher than the average for the industry. And so to ensure that they can keep doing that, making cuts probably makes sense. And I've seen cuts where they've made significant cuts and it hasn't really impacted production. And so those are the sort of cuts they're trying to make, cutting not at site, but at corporate.
Barrick Gold, I seem to recall, did something similar after the Randgold merger. There was a lot of cuts at the Toronto head office then. Newmont has returned more than $1.9 billion to shareholders this year, and presumably a lot more to come in the second half of the year. On a more positive note, Pan American Silver has completed the acquisition of MAG Silver and got the 44% ownership interest in the big silver mine in Zacatecas in Mexico. Congratulations to them. With silver hot and getting hotter, we are seeing the power of acquisitions to deliver both alpha and beta. A case in point is Kitco Mining, which bought Silvercrest earlier this year and now has a higher market capitalization by $1 billion than B2Gold, despite producing 500,000 ounces of gold equivalent compared to B2Gold's 800,000 ounces of gold equivalent. Joe, Core is getting some serious leverage, it seems.
Yes. So year to date, Core is up about 144%. B2 Gold is up about 70%. So B2 Gold has On the US, BTG has underperformed both the GDX and the GDXJ, which are up 83 and 96% as of the close of yesterday. So Core has obviously outperformed the benchmarks as well as B2 Gold. And I think a lot of that's related to one, like you said, they bought Silvercrest in an all-share transaction. Since that transaction, which was all shares, their shares have gone up another like 140%. So that's good. And that Silvercrest acquisition brought in cash flow and also more silver production. So that gave them even more leverage to silver. And there's a silver investor out there that's just looking for silver dominant companies, and there's few of them out there. And Core has obviously been attractive to people. And so Silvercrest has a good, decent balance sheet. They've generate a decent margin at about 48 to 50%. They're generating in the first half of this year, generate about $270 million of free cash flow. They don't do dividends, which probably doesn't attract that crowd, but it definitely attracts the crowd that's interested in silver. Why B2 Gold is probably laid back a bit is because they don't have the silver component, so they don't get that kind of investor. They do issue dividends. They issued, I think, 2 cent per share quarterly dividend. But their problem is, Goose is still not into commercial production. So a lot of the costs for Goose, net of any revenue they made is taken as capital, and that's dragged on. So they haven't, generated hardly any free cash flow in the first half. I put it just barely positive at $2 million, and their balance sheet is nowhere near as nice as Core's. I mean, I think they got a $430 million net debt position. They're hoping to get that Goose into commercial production in September, during the Precious Metal Summit, I would gather. So that would help B2 Gold going forward.
So B2 Gold's potentially got a turnaround aspect to it. The 2 cent per share dividend you mentioned, that was a reduced dividend. The company cut its dividend last year. I think it used to be 6 cents per share. And I believe that as and when Goose is running and cash flowing, one of the key aims of the company is a share buyback program. So potentially some good catalysts for B2 Gold going forward. Gold is running high, silver is running high, and so is the red metal copper. Copper hit $10,000 per ton again. And while money should be flowing in, Teck Resources continues to have difficulties. The company has launched a comprehensive operations review to improve its performance, including an action plan for its Quebrada Blanca project or mining complex in Chile. And the company said it's postponing other major growth projects until Quebrada Blanca achieves steady state operations. Joe, Teck's pivot away from coal to reposition as a pure play energy transitions metals business focused on copper, that really hasn't gone as planned. Is it a case of perhaps the wrong strategy at the wrong time? Is it poor execution, or is it just bad luck?
I think the timing was good in terms of the market, but I would go with poor execution on QB2. We've already talked previously, probably for a couple of years, about the escalating capital and changing scope of QB2 that's cost more and more as they went further. And now the issue seems to be, them getting the tailings facility up and running to capacity. There are some other issues with the port that they got dedicated to Quebrada Blanca, but it's more of an issue on the tailings. And like you said, like them changing their plans, in terms of, and I think good that they're changing their plans on capital. You can't keep spending capital if you're going to have to go back to the markets for more capital if QB2, keeps delaying in terms of generating positive free cash flow, because they're not generating positive free cash flow. They're not even generating positive operating cash flow, which is a big negative over the first half of 2025. So, and then the only way they've had any, ingress of capital over the last year, 4 quarters, is from the sale of the coal unit, which brought in about, $9 billion or so. But otherwise, that's the only reason their balance sheet's better than it was at the end of the first half of last year. Otherwise, it's not free cash flow that's making it any better. So they're not gaining that much leverage to a move in the copper price. because of poor execution on Quebrada Blanca. I know they're also talking about an expansion of Highland Valley. Hopefully they can do that one better than they did QB2.
Okay, QB2 came in about, I think, $4 billion over budget, if I remember correctly.
Yeah.
I want to use this, maybe we can do an aside from this, Joe.
But what I would point out on QB2, that wasn't just one change. They had sequential changes, and sometimes that budget blew up after they just announced an update like 6 months prior. So their the market has no confidence probably in them. And so the new person that's coming in, an executive that's coming in to manage this tailings facility, is going to report directly, I think, to the CEO. That's how important it is, and that's how important they want to show to shareholders that they're taking this, because they have to show that they can actually meet expectations that they set, and not being able to execute will consistently give you a discount to market going forward until you can start doing what you say.
Okay, let's use this as a springboard into another talking point. With metals prices high, a number of companies are making good money and they're getting a lot of cash on their balance sheets, and so capital allocation is becoming more of an issue in a sort of positive way. But does the failure, the poor execution of Teck at QB2, it reminds people of the excesses of the last cycle, let's say 15 years ago. Does this sort of encapsulate investor fears about companies having too much time and money on their hands and potentially thinking of wonderful ways of spending that? Is there still a fear there that companies are going to blow their brains out on something again?
Yes, but a lot of the blowing of the brains out, as you put it, was poor M&A transactions. As you could see, a lot of the M&A that we're talking about, like the Silvercrest Coeur, actually ended up being pretty good. In terms of the share price accretion, cash flow generation, that worked out pretty well. Quebrada Blanca is more about poor execution of the actual build, which the capital intensity wise per ton of copper is explosive in terms of that project. That puts the fear of God in other people that are looking at building these $4 or $5 billion projects. Are they going to be $7 to $8 billion projects? That's really why more M&A is being done on production than it's being done on development. If it's something that people can control, not infrastructurally challenged, because QB2 was sold as a brownfield expansion. And we've talked about this before, like brownfield expansion, that should be incremental, should be a big deal. But totally different mine, because now you're mining the primary sulfides and you're not doing a solvent extraction electrowinning and shipping out cathode. Now you're shipping out a concentrate. Now you need a mill, concentrated facility. You need a port facility because now you're shipping out concentrates. You can't use a smaller facility. All of that, and then you need more power, rocks harder, all that other stuff. You need more water. So all that infrastructure, basically gets more expensive and more expensive. Which bodes well for the copper market, because as most copper players, companies would tell you, that the incentive price to build these projects isn't there yet. The copper project can continue to be, in terms of production, sort of, the deficit coming up is serious potentially, because a lot of the probable projects may not get built because of the issue that QB2 has had.
Okay, as you mentioned earlier, Joe, it's the Precious Metal Summit next week. You'll be there, I'll be there. We'll be filming for Kitco, so please come by and say hello. And we know that a conference is coming up because we're getting a lot of feasibility studies, pre-feasibility studies, resource updates, and preliminary economic assessments coming out. Quebec gold developers, Amex Exploration, and Fury Gold Mines have announced PEAs in the last few days for their respective Perron and Eau Claire projects. Both start with a few years of toll processing to lower initial capex, to then fund plant construction from cash flow after a few years. Joe, this may be relevant to what we've been talking about QB2, but it seems stage develop is becoming more of a norm to manage initial capex, to lower initial capex. Why is this, do you think?
Well, I think people don't want to see a big capital number. And if you can't get out of showing a big capital number, because it is a big capital number to build that kind of a plant for potentially a lower grade deposit, then you try to say, oh, hey, this is really the capital number. So you don't want to scare anybody to say, this is something I can raise, I can do. But we've seen this before, and this might be different, but everybody says that in terms of, okay, once I get going, I'll generate more cash flow, and then I'll be able to fund this myself, or I'll have a lower cost of capital. And, then banks will lend to me on better terms. I haven't seen this happen very, very often, and so I'll always be wary of that. And a scoping study, as we all know, is probably the best foot forward in a lot of the capital and operating costs. And so you want to really know for somebody that starts toll milling, who's going to get the ore, and is it important to that plant? If it's not important to that plant, then if they have more capacity and they find their own stuff, does the stuff from Fury get put to the side? How good is that the contract? Do they have other options? And toll milling, it's hard to make a lot of money toll milling because you're at the behest of the plant that's taking your material.
Well, both of these projects are in Quebec, where there are a number of milling operations. So, but I think it remains to be seen which mills they're going to use. Neither of them have a contract in place yet. Both projects have eye-watering economics, with base case IRRs of 70% and 41% respectively. Joey, in the current price environment, it must be pretty hard to deliver bad economics on a project. And so when you're looking at sort of studies, how do you separate good projects from the mediocre now when everybody's got at least 40% IRR?
It depends on the project. Like I would look at the jurisdiction, because we're seeing what's happening in some places in West Africa, that you put out your PEA, you put out your scoping study or feasibility study, and suddenly the government wants a bigger stake in the project, and suddenly you're in a trading halt. That can be an issue. Jurisdiction's one thing, infrastructure is another thing. And so if you look at the capital number and it's not in an infrastructurally challenged area, that capital number could be closer to the truth, especially if it's in a PFS or a feasibility study document as opposed to a scoping study. And then you look at, what is the process? Is it a mill? How much power do they need? Is there power? How much does the power cost? What is their exposure? Is there water? Because as we know, water is hard, very competitive, and you can't compete for potable water. The bigger the plant, the more water you need. How permittable is it? Are there any issues with social license to operate? All that sort of stuff comes in just to the basics of whether this is a buildable project. And then you get into the mechanics of, does that flow sheet make any sense? Is that going to be the head grade? Because this is all indicated and it's underground. What's the dilution actually going to be? So then you start questioning parts of the study that you think may or may not work. And the more things you start questioning, then you get up to the capital numbers and the operating costs that usually run these IRRs back down to below 10%.
Okay. Now, as mentioned, the Precious Metals Summit is in Beaver Creek in Colorado next week. Joe, what are you looking forward to from the event?
It's a high intensity event, and a lot of meetings. I think I've got like 33. I try to not go to there and say, hey, I had 60 meetings, because I would be dead after that. I think my takeaway is that this is the first big conference post the run-up on gold that I've been to. Like I was in Boca at Rick Rule's conference in July, but now we've had the financial results come out for a lot of these companies. People are cashed up. Now what? We've seen a big return of money to shareholders by a lot of companies. Is that the future? Are people looking to grow? How do they expand? Are all the the low hanging fruit producing assets already purchased? The overhang of Newmont's divestitures are gone. Are we going to see a move to acquire development assets? Are people going to take that risk of, capital and permitting risk to acquire some of these development assets, which some of them are still very, undervalued. I would say. So will people take risks? And I'd like to see some of that M&A and see if that's something we see out of these next conferences.
With the $200 per ounce move in the gold price in the last week or so, I think it's been noticed we started to see the share prices of some of those development assets really start to move. And so there does perhaps seem to be a bit of excitement or expectation that that benefit is trickling down to the smaller companies, the non-producing assets. I've spoken to a number of them in anticipation in the run-up to Beaver Creek, and a lot of them say that half of their meeting calendar is with producers, with corporates. And so it does seem that there's going to be some very serious tire kicking going on at Beaver Creek.
Yeah, but I mean, we always have that, probably now more so than ever. But I worked in M&A for corporate development for Newmont. Yeah, that's your job, is to kick tires. And you always want to see the assets that make the most sense to you. But you will look at anything because you gain information by talking to people. So I would say that, yeah, that will be, and the Precious Metals Summit overall, because the way institutional equity has fallen off, has become more of a corporate conference, because there's been a lot more companies, corporates attending that conference over the last few years, probably about at least 5. And it's an easy way for them to see a lot of companies at that stage, at a junior stage, very quickly. And so, it's probably one of the better venues to do that, with PDAC as well, but that's multi-commodity. This is potentially more for gold specific. And so,
with so many positives at the moment, Joe, is there a note of caution out there? Should there be a note of caution out there? And if so, what could that be?
Yeah, I mean, the big note of caution would be if we could lower global tensions, if something happened that brought that down, if some of these tariffs came down as well, and the political environment was a bit better. But I think the underlying thematic is that the U.S. government, or the U.S. administration right now, is making a big push to lower interest rates. So that underpinning for gold is positive, and has been positive. And then the knock-on impact, since this is happening in the U.S., will be to gold equity ETFs, and then go to gold equities, and hopefully that'll trickle down. And as we've seen already, to financings for a lot of companies, a lot of the boon in financing over the last few months has been gold companies, being able to raise money. And some of these guys didn't need money. They were just given it. So we're definitely seeing that kind of market. And I just saw an ad for a brokerage firm, looking for an analyst. And, for the last few years, they were firing them, and now they're actually looking for them. And so that's another thing. That's a sign of, the market taking a turn. So more field visits, as people have more money to show people their wares, but when things are looking this good, you always should be wary. And the best way of handling that potential for a turnaround is still focusing in on the better projects, the better people, and the better jurisdictions. And so you don't have to take a phone call or read a news release in the middle of the night that, suddenly your company's project is getting nationalized.
Okay, well, I'm looking forward to catching up with you next week. Joe Mazumdar, thank you very much for joining me today.
All right. Thank you very much, Paul.
And if you like what you see, don't forget to hit that subscribe button. I'm Paul Harris, and this is Kitco Mining.